Asia this week. And this is what he had to say in terms of a timetable on when.
Well, JSW Steel has reported in-line set of numbers as compared to what the street was estimating. Revenue has grown by as much as 4.3%, and if you look at the EBITDA performance, that however has declined by around 16% year-on-year basis for the company. But then we're being joined by the management of the company, Mr. Seshagiri Rao, and welcome to Bloomberg.
Thank you.
So I'm going to start by asking you about the export sales volume, which has seen a dip around 34%. I do understand that you have maintained very good volume growth in this year and have given a very optimistic scenario even for the next year, even when the demand slows down. But how do we deal with the export sales volume right now?
Exports year on year have fallen. In FY18 we have exported 3.6 million ton, whereas FY19 it came down to 2.4 million ton. So overall export volumes for the year has come down. But if you see the 9 months of the last financial year and the last quarter we have exported more.
Right.
It is over 9 lakh ton.
Right.
It is 22% of our volumes for exports in the last year.
Right.
So when we are focusing on the domestic market more and exports, when we have moderated quite significantly in the first 9 months, there is the accumulation of inventory of over 4 lakh tons in the company. So Q4 we have taken a call that we have to reduce the inventories.
Right.
Even if required, we have to export. So that is where we focused in the Q4. We exported quantities in the Q4 of the last year. Then we reduced our inventory, which was 13.95 lakh ton as on 31st December 2018. We brought down to 9.46 lakh tons. So we reduced the inventory more than 4 lakh tons. That is the reason why you will see the consolidated volume of sales in the Q4 was 4.31 million tons, which is a growth of 3% over last year. This is contributed majorly by higher export volumes in the Q4.
Okay, a lot had been done in the NDA 1 rule of the government in terms of the protection of the industry. But now with the ongoing trade war concerns, what are the discussion on table? Any measures that we can expect?
Number one, it is not a protection, it is only we are requesting that the dumping should not hurt the domestic industry. Government has taken certain steps in the year 15-16 year. It was quite timely, so that has reduced the imports. But at that time when these steps were taken, the global steel prices were below $300. That's why they have put the duties accordingly at that time, or the reference prices accordingly at that time. After 2016, the international steel prices went up. They went up as high as $600 per ton. So therefore they are not effective today. The reference prices or actions that have been taken by the government in the year 15, 16, 17, they are no more relevant. The imports are increasing into India. Particularly Q4 imports have gone up quite substantially. So in this context, what we are looking at the government is to immediately take steps the way Europe has done, the way USA has done, the way Turkey has done, the way Canada has done. They put suo motu duty.
Right.
Similarly, India also should do at least 25% suo motu duty. Thereby, these imports will not fall. No diversion of trade from Japan and Korea come to India. Because if I see entire last year, FY19, their exports to USA has fallen, and India it gone up by 500,000 ton, more than 500,000 ton. It's clear trade diversion of exports which they are not able to do. They are bringing into India.
Yeah.
So it is very essential that the government will take immediate steps, thereby the industry does not suffer.
Sure. And talking a little bit about the cost inflationary pressures, especially in light of the rising iron ore prices that we've been witnessing, I'd like to understand what's your iron ore strategy going forward, because I think out of 6 mines, all of them are going to be operational by FY20. You're also going to be increasing your overall production capacity, which means higher iron ore. So what kind of iron ore requirement would you have in FY20 as compared to FY19, and how much of that will be sourced?
Our total iron ore requirement at the capacity at which we wanted to operate, in fact in this year we wanted to operate at 95-96%.
Right.
Last year our capacity utilization was 93%. So considering that we require around 31-32 million ton of iron ore for all the 3 locations together. Out of that, our captive iron ore mines are expected to give us at least to the extent of 5 million tons. So if I take out that balance, we have to procure.
Right.
Our intention is to get this iron ore locally, either from Orissa, Chhattisgarh or Karnataka. If it is not available for any reason, then we may have to rely upon getting from outside India. We are working towards that to procure iron ore, but our thinking is a lot of iron ore mines are getting auctioned by 31st March 2020.
Right.
That they are expiring.
Right.
So many of the mining companies are trying to maximize the iron ore production
Right.
in this year. So there will be more supplies of iron ore, at least in the Indian market, if not in the global markets.
Correct.
So therefore, there may not be any need to rely upon imports. We will be able to get from domestic market. That is how we are seeing.
All right, just in case if the March 2020 auctions don't happen in the given time frame, and also if the domestic suppliers do not ramp up the capacity, the hypothetical situation or the obvious situation that we are working with right now, in that case, do you see your cost per ton going higher if you don't see the required amount of reduction in iron ore prices? If you can also put a number to what level are you looking at for iron ore by the end of this financial year?
It is very difficult to say what happens as regards to iron ore pricing is concerned. But my understanding of today's surge in iron ore prices globally is because of disruption.
Right.
That disruption, the market understands it is 70 million ton, but if you analyze overall, it may be 30-40 million tons of iron ore. This is very, very temporary and short term. So if you see a lot of analyst reports, they are talking about the second half of this calendar year, iron ore prices will normalize because more supplies will come or Vale will restart the operation. So one of these 2 things will happen.
Right.
Therefore, I don't expect the iron ore prices today above $100 will sustain going forward in future. So once they normalize, I don't expect the demand supply scenario is structurally changing. It remains as it was in the past, where the iron ore price is $60-65 per ton. So in my view, if not to that level, iron ore prices in the second half will come down below $80 per ton. So there are a lot of options that would be available to the company to source iron ore either locally, if it is not available, to source from outside. Different grades of iron ore is available. The way we have done in the past, the way we have managed in the past, we will continue to do that.
All right, fair enough. In terms of your coking coal prices, sir, what's the trend right now? Are we seeing any kind of increment there, and your outlook for the next financial year?
Coking coal prices, they have not moved the way iron ore prices have moved,
right,
which shows that the demand is almost similar to what we have seen in the past. Because of disruption in the Australian markets, the coking coal prices we have seen reaching 230 plus, but they have got corrected. Now they are in the range of $200, $205. That is the range we are seeing. So we don't expect a big jump in the coking coal prices. They are in the range bound in the next year. So I don't expect a pressure on account of coking coal prices.
Okay, fair enough. In that case, let's focus a little bit about your net debt. Standalone net debt is around 46,000 odd crore,
right,
and further with the integration of Bhushan Power and Steel, that debt is expected to increase. I'd like to understand what is your operating leverage target for the next financial year. The net debt to EBITDA this time around was around 2.4 times. So how do you see that panning out?
No, in fact, if you compare FY 18 and FY 19, even though the debt has gone up in absolute number,
right,
if you see debt to EBITDA or debt to net worth, they improved.
Correct.
If I look at FY 18, the debt to EBITDA number was 2.57,
right,
which fell to 2.43.
Right.
So there is a significant improvement.
Right.
Same story in the case of debt to net worth, which was 1.38 in FY 18, it came down to 1.34.
Right.
So ratio side and the overall strength of the balance sheet is concerned, I don't think there is any problem. We have been guiding the market that we will be 3.75 debt to EBITDA and 1.75 debt to equity.
Yeah.
We have a huge headroom available within those parameters.
Right.
So I don't expect even after completing all this capex program, we will be anytime very near to those
3.75 levels.
3.75 levels.
And when do you see the capex program completing by? FY 2022?
FY 21.
21. Okay, so 3.75.
FY 20 significant portion gets completed. Balance will get completed in 21.
So in that case, can I expect the net debt to EBITDA to stay around the current levels for FY20, if not improve?
We don't want to comment a specific ratio, whether it is 2.43 or it is 2.6 or it will be 2.2. What we can guide, because we never guide on EBITDA, so therefore it is very difficult for me to say.
Yeah, a figure northward to that?
We have a ratio of 3.75, we will live within that.
Okay, all right. I just tried my luck for FY20. In that case, Bhushan Power and Steel, what's the update there?
Bhushan Power and Steel, as and when we decide to go ahead based on the court order, then we have a similar structure as I was explaining to you, like Monnet Ispat.
Yeah.
So therefore, we don't want to consolidate in the books of JSW Steel. So we'll work out a structure in that manner. We'll be able to share more information on that. So therefore, even assuming Bhushan Power and Steel will happen, it will strain the balance sheet of JSW.
Right. So what's the option on table for us right now?
Means?
If we don't integrate it completely, then what's the option on table?
The way we are operating today in the joint control, Monnet Ispat,
right.
A similar structure will be there in Bhushan Power and Steel.
Sure. In that case, could you explain a little bit about your incremental or the fresh capex that you've been planning of around 5,700 crore, and specifically in light of the rising debt scenario, would that kind of strain the balance sheet, or is that expected to it would be seen in isolation basis? How does that work?
Not in that way, because last year we have spent 9,600 crores. In this year, our capex program is 15,700 crores. Out of these 15,700 crores, 10,000 crores will be spending out of debt, balance out of cash accruals of the company. Therefore, there is not an issue with regard to meeting this capex program. If I see 4 years period starting from 18, our entire capex program, including the 5,700 crores which we committed in this year, is 48,000 crores. Out of 48,000 crores, 28,000 crores is the debt, balance 20,000 crores is the equity. Equity means cash accruals, which will be spending over a period of time.
Right.
Whatever we have spent in FY18, whatever we have spent in FY19, if I take out those two expenditures which are already incurred, balance left out of this 48 is 34,000. Out of 34,000 crores, again we will be spending 15,700 crores in this year, balance will be spending in 2021. So debt or cash accruals available in the company to meet this capex program, I don't find any challenges in that.
Okay. All right. In that case, let's talk about the expansions. Your Dolvi expansion, which seems to be on track, March 2020 is on target, 10 million ton capacity expansion from 5
to 10.
Yes, that's an incremental 5 MTPA capacity.
Correct.
Apart from that, Vijayanagar upgradation, however, has taken a back seat. It has been delayed after March 2020. What explains that?
It is not a delay, because BF3 requires revamping, requires shutdown for 120 days. So when we wanted to take this shutdown of 120 days, we wanted to use that opportunity to increase BF3 capacity from 3 million ton to 4.5 million ton.
Right.
With that, we have made all the arrangements. Whereas the operation of the blast furnace 3 in the last few months, if we see, it is stabilized, it is operating quite well. It is possible to postpone the shutdown for some more time without taking the shutdown of 120 days in this year. Where I lose the production, I lose the incremental EBITDA.
Right.
So we have kept everything ready. If in the eventuality of something happens in the BF3, at that time anyhow we will take the shutdown.
Okay.
But we don't want to plan that shutdown in this year when there is a potential of earning more EBITDA by not shutting down. And this shutdown we can take as and when our expansion at Dolvi happens. So keeping that in view, when we technical team is satisfied that the BF3 life can be extended further without any issues. So we have postponed the shutdown from this year and we are operating BF3 at full capacity. That is why you have seen 1.5% growth in our guidance in volume and sales.
Okay. In that case, the last question that I have will relate to your overseas subsidiary, both Ohio as well as Italy, because they both have been reporting losses on EBITDA level. When can we expect a turnaround happening on those two subsidiaries?
I think Italy will be faster relative to USA. USA we are working, its stabilization is taking a little longer time. So I think in this financial year we will be able to turn around and make them black.
So faster for you said Italy as compared to Ohio.
Yes.
So for Italy, what's the target there in this financial year? You mean?
Yeah, in this financial year it will happen.
So
Yes.
the first quarter, second quarter. When can we expect?
Maybe second and third quarter.
Okay, and by the end of it would be second would be your Italy and third would be, I'm assuming,
Yes.
the Ohio subsidiary in that case. All right, sir. Thank you so much for your time. Indeed, a pleasure
Thank you.
speaking
Thank
to you.
you.